Let me ask you a quick question. Would you ever take a pay rise that actually leaves you with less money in your bank account? It sounds completely backwards, doesn't it? But it's a very real thing.
Now, this isn't some trick question. It's a genuine and kind of sneaky feature of the UK tax system. And understanding how this works is absolutely crucial if you want to make sure your hard-earned cash actually stays with you.
So welcome. This guide is brought to you by the folks at My Tax Accountant. We are going to pull back the curtain on one of the most confusing parts of UK tax, the marginal tax bracket. We'll break down what it is, why it matters so much, and what you need to know for the 2025/26 tax year.
So here's what we've got on the cards. First, we'll figure out what your next pound of earnings really costs you. Then, we'll climb the tax ladder to see how the system is supposed to work before, and this is the important bit, we uncover the hidden traps where it all goes wrong. We'll also touch on things for business owners, give you a tax-saving toolkit, and then help you plan your next move.
All right, let's get right into it. Section 1 is all about this core idea. I want you to forget your total salary for a second, because when you're looking at a bonus or some overtime, the most important number is what the very next pound you earn is going to cost you in tax. It's all about what you keep.
So, what on earth is a marginal tax rate? Well, to put it simply, it's the slice of tax that gets taken from the very next pound you earn. This is not your average tax rate. No, this is the rate that applies to any extra income. This is the number that really tells you whether taking on that new client or working those extra hours is actually worth it.
Okay, so let's talk about how the system is meant to work in theory. The UK has what's called a progressive tax system. It just means the more you earn, the higher your tax rate gets. But there's a huge myth that if you get a pay rise that pushes you into a higher tax bracket, your entire salary suddenly gets taxed at that higher rate. That is absolutely not true. Let's see why.
Just picture it like climbing a ladder, right? Everyone in the UK starts on the ground floor with their tax-free personal allowance. As your income goes up, you start climbing the rungs, but you only pay the next rate of tax on the bit of your income that falls into that specific rung or band. The money you earned on the lower rungs is still taxed at those lower rates.
Okay, so here are the actual numbers for the 2025/26 tax year for England, Wales, and Northern Ireland. As you can see, you pay nothing on the first £12,500, give or take. Then, the next chunk, up to just over £50,000, is taxed at 20%. And only when you go past that does the 40% higher rate kick in. And for the really high earners, it's 45% on anything over £125,140.
Let's make this crystal clear. Let's meet Sarah. She's an IT consultant in London, and she earns £55,000. So her first £12,570 is completely tax-free, zero. The next big chunk is taxed at 20%. Now look closely. It's only that final bit of her salary, the £4,730 that tips over the higher rate threshold, that gets taxed at 40%. So while her marginal tax rate is 40%, her average rate, her total tax bill divided by her salary, is way lower, only about 17%. See the difference?
So, that all seems pretty simple, doesn't it? Well, that's not all. Here's where most people get tripped up. That nice, simple ladder we just climbed, it has some pretty nasty broken rungs. Stay with me here. The next bit might genuinely shock you. This is where earning more can literally cost you money.
I want you to burn this number into your brain, £100,000. In the UK tax system, this isn't just a nice round number. It's a landmine. It's the point where all the simple rules we just talked about get thrown out the window. And here it is, the first big trap. For every single pound you earn between £100,000 and £125,140, your real effective marginal tax rate is not 40%. It's an eye-watering 60%. You heard that right, 60%. That means if you get a £10,000 pay rise in this bracket, you only actually see £4,000 of it.
So you're probably asking, how is that even possible? Well, it's a bit of a sneaky one. For every £2 you earn over that £100,000 mark, the government takes away £1 of your tax-free personal allowance. So you're paying 40% tax on that extra income, and you're losing a tax-free allowance, which is equivalent to paying another 20% tax. Add them together, and you get that 60% hit. It's a tax on your tax break.
And believe it or not, it doesn't even stop there. There are other cliff edges. For families, the high-income child benefit charge starts to kick in from £60,000, creating crazy high marginal rates. And at that same $100,000 point, you can suddenly lose all of your tax-free childcare support. The effective tax rates can become truly astronomical.
Okay, so what if you run your own business? If you're a freelancer or a contractor in London, this affects you too, just in a slightly different way. The principles are the same, but the structure of your business creates its own set of challenges and opportunities.
So if you're self-employed, you're paying income tax on your profits, not a salary, and you pay different types of national insurance. Once you get past that higher rate threshold, that $50,270 mark, you'll be paying your 40% income tax plus 2% in Class 4 national insurance. So your marginal rate is actually 42%.
Now, for you limited company directors out there, there's a classic strategy for a reason. You take a small, super tax-efficient salary, usually just enough to use up your personal allowance, and then you take the rest of your profits out as dividends. Dividends have their own lower tax rates, and crucially, you don't pay national insurance on them. This can make a huge difference, but you still have to be so careful that those dividends don't push your total income over one of those cliff edges we talked about.
Right, we've seen the problems, we've seen the traps. It can all feel a bit daunting, I get it. But this is the good part. This is where we talk about how you fight back. The key is knowing how to plan. There are powerful and totally legal tools you can use to take back control of your earnings.
And here's a massive pro tip for you. Pensions are your absolute secret weapon here, especially for dodging that insane 60% trap. When you make a pension contribution, it lowers something called your adjusted net income. If you can contribute enough to bring that income number back down to £100,000, you get your entire personal allowance back. Boom. And the best part? You get tax relief at your highest rate. So for a higher rate taxpayer, a £10,000 contribution to your pension only actually costs you $6,000. It's a no-brainer.
And the toolkit doesn't end there. You've got your annual £20,000 ISA allowance to save and invest completely tax-free. And did you know this? If you make charitable donations using gift aid, it actually extends your basic rate tax band, which can pull some of your income out of that 40% bracket. Then there are salary sacrifice schemes, where you can swap some of your taxable salary for things like an electric car, which lowers your income before the taxman even looks at it.
Phew, we have covered a ton of ground here. We've gone from the very basics to the really complex traps and thankfully to some powerful solutions. So let's just pull this all together and talk about getting the right support for your own situation.
So here's a quick cheat sheet for you with the most important numbers for the 2025/26 tax year. These are the thresholds you really need to keep in your head. Knowing when the higher rate starts, when that personal allowance starts to vanish, and when the child benefit charge kicks in, that's step one to really smart financial planning.
Look, if your head is spinning a little bit, that is perfectly okay. The UK tax system is famously complicated. These traps and hidden rates are not designed to be obvious, and trying to navigate it all on your own can be seriously stressful. But the good news is, you really don't have to.
If you want clear advice that's tailored to exactly your situation, the experts at My Tax Accountant are here to help. They can look at your income, help you use all the right allowances, and make sure you're not paying a single penny more in tax than you legally have to. You can see their details right there on the screen.
So, I'll leave you with this question. Now that you know what your next pound really costs, what's your plan to protect it? If you found this guide useful and you want more clear, no-nonsense financial guidance from My Tax Accountant, make sure you hit that subscribe button on their channel. Thanks for joining this discussion.